Just checking. Yeah, I'm just turned on properly. Apologies. Yeah, we do get Apple results, of course. And certainly the stock has lost its luster this year, tumbling over 10% or so. iPhone maker is expected to post a decline in the first quarter in earnings after smartphone shipments fell 19%. So watch out for that. Long-term giant trend really from those highs in December at well, just below $200. You can see that blue line is the 50-day moving average. Again, capped the upside previously. So yeah, whether we roll over, and if I just pull it out, you can see that sort of fib level around 170.87, and then that swing low from late last year at 165.67. That did act as support previously, so just watch out for that. That'll be interesting if we do approach it soon on their numbers, which are out on Thursday, as I say. Otherwise, well, interesting reaction for the indices, at least. If we just look at the S&P 500, turned down lower, but really last week it was actually its best week since. And if I just show you its best week since November, with global tech really leading the way, rising 5%, really offsetting some of the underperformance we'd seen in the weeks leading up to the big tech reporting. As I say, though, yesterday's sell-off did mean actually we closed out the worst month of 2024. 10 out of the 11 sectors on the S&P 500 posted yeah, their biggest monthly percentage decline this year. If we just look at that, the S&P 500, it was down 4.2% in April, first monthly decline since, you can see, October of last year. And if we just look at the technicals, yeah, certainly sort of 5,000 is always a key level, key psychological level. Then you've got this initial fib level, which did cap the downside in the middle of last month, just below 5,004,990. So again, watch out for that area of support potentially. If we do lose that, then yeah, we could move quite sharply lower. Next fib level at 48.21 in the S&P 500. For the Nasdaq, sort of similar type move, ended up down around 4% or so on the month. First down month since October as well, you can see there. And that was after a pretty solid week, as I said last week. Anyway, yeah, first fib level 17,424. This is Nasdaq 100. Otherwise, we lose that, then 17,000 was a psychological level again, with a fib level just below that at 16,781. As for the Dow, that posted a 5% loss on the month. That was its biggest drop actually since September 2022, which is here. You can see there, big drop after consecutive months of gains, and since October. If we just look at the daily then, no longer, of course, in a bull channel. This is pretty serious support now around sort of 37. 700, 800 or so. So just watch this level. Otherwise, potentially then 37,000 on the nose is that fib level, retracement level of 38.2 of this long-term rally. Yeah, that's around 37,000. Okay, next up, let's go to a couple of charts now. This is, of course, just showing you Amazon's outperformance against Apple, down, yeah, 12% or so. That was on the 25th, whereas Amazon doing quite well and up again another 3% or so. Yeah, so there's that chart there. If we then just look at, well, first of all, just before we get to just having a look at some of the key data recently come out, in the euro area, we did, just before we look at the inflation numbers, PMI numbers, just quite interesting last week, just because they really show, suggest that the economy is now back in growth territory, really leaving stagnation behind for the second consecutive month. So the composite PMI, that rose more than expected again. Although the economy is driving at two speeds really. So you've got services, the services sector again posting an upward surprise, whereas manufacturing unexpectedly declined again, really. But it does overall paint a reasonably upbeat picture of the Eurozone economy. Unemployment still at record lows, inflation fairly benign, rate cuts to come. So the outlook is slightly more pleasant, certainly, than it has been, of course, coming from a low base as well. Don't forget. That was that PMI. UK, yeah, if we just look at the Eurozone inflation data now, that came out yesterday, of course. HICP, known in the Eurozone headline, that came in at 2.4%, was expected, unchanged from the prior month. But the core was interesting. That ticked up 1/10 higher than expected at 2.7%. Consensus saw 2.6, although it did decline 0.2 from the March print of 2.9%. The headline, that was unchanged, as really food inflation picked up while energy prices dropped less quickly. And then the services inflation number, again, the important number for market watchers, certainly. That came in at 0.35% month on month, which really kind of doesn't tally still with 2% annual inflation. And it poses really an upside risk to the inflation outlook going forward. Momentum in services inflation, just to reiterate, has been strong in the first months of 2024. And that has or will be slightly concerning for the ECB and certainly for the hawks at the ECB. We did get GDP as well, just to confirm sort of that slightly better picture in the Eurozone, more than consensus expected, 0.3% growth, consensus was 0.1, although the Q4 number was revised down to flat. Yeah, was resigned down from, flat to negative 0.1%, so downward revision. But all in all, probably looking at all that data then, including inflation data, kind of cloudy, muddy picture really as we get closer to 2%, the inflation target. And regarding policy then, the ECB certainly is data dependent, but yesterday's data could mean, well, the ECB takes slightly more time in normalizing rates. Probably can afford to do so because of those signs, more positive signs, a bit of a pickup. And then, as I say, unemployment still remaining at record lows. The first cut is priced still for June. And if we just look at euro dollar then, which is here. Yeah, interesting, obviously. Well, first of all, it's a Labor Day holiday in Europe. Just be aware of that. But certainly then the dollar side of this currency pair will for sure impact this with the Fed coming up. But anyway, yeah, was just struggling around 107, 106, sort of the next area, major area of support that you can see. If we lose that, then we're down to sort of 105 region or so. It's pretty simple, really. Round numbers to look out for. If we do break probably last week's high at 107.52, then we have the 100, 200-day and 50-day moving averages around the halfway point of the Q4 rally at 107.93. You can see there that dotted line. Okay, let's also now go to first of all, just some data, US data last week, just checking where we were. Just that GDP data, just to review quickly, 1.6% the headline, so missed consensus by a big margin. But the details showed underlying strength in consumption and investments. Key though in this report, and everybody kind of was slightly, a lot of people's thrown because of the miss, but it was the detail in the report around the quarterly PC price gauges that really flanked that growth number. They were seen accelerating more than expected, 2% quarter on quarter to 3.7%, matching the fastest pace since Q1 of last year. And that really strengthens the view about what we've been getting from the CPI reports, and inflation is re-accelerating away from, well, this 2% inflation target that seems ever further away at the moment. Again, that data warrants the current potentially higher for longer market positioning, which is probably going to be cemented at tonight's FOMC meeting. The Friday PCE inflation figures, they came in as expected then, 0.3% month on month. Price gauge rose 2.8%, so more than consensus expectations. Reaction was relatively muted because of the big reaction previously on the previous day with those quarterly price PCE gauges. Okay, I just probably will go now to the Fed meeting. I was going to look at Japan, but I'll look at that. I'll wrap up everything with Japan and just the intervention that we've seen in dollar yen. But just going to the Fed then, first of all, if I just pull up a graphic, first of all, with a preview really of all the main numbers that you can see here. So yeah, FOMC expected to hold rates at 5.25% to 5.5%, 22-year high, I think, at the meeting tonight. Strong income data. We've seen, of course, sticky inflation, 3.5%, that headline rate now up for a third straight month. Biggest gain is 6 months, as I put here, and it is really core CPI at 0.4%. That has hit 0.4 for 3 straight months, really more than double the rate needed that economists reckon that we need to see to bring down the inflation rate below or towards the 2% target. I think the month-on-month core rate we need is around 0.17% for a protracted period, and certainly we're nowhere near that at the moment. Also, of course, solid labour market numbers, 303, the headline NFP last time around. And of course, GDP growth as well has been pretty solid going forward. It is meant to be as well. That is all meant to keep the central bank, the Fed, cautious, data dependent. Of course, the recent meeting minutes said that almost all participants judged it would be appropriate to pivot to a less restrictive policy stance at some point this year. But of course, we've had more data since that point in time. And really people are talking about whether Powell then unpivots his previous pivot, if you like. Markets really expect him to acknowledge those recent upside surprises then in data, in inflation data for sure. Expected to sound less dovish and repeat really his recent comments that the Fed will keep the current level of restriction for as long as is needed as high inflation, if high inflation persists. And certainly activity then generally holding up really well, and that means then any easing this year will have to be delayed. That's the kind of message that most consensus really expecting from Powell. If we just look, well, I put in here pricing, actually markets pricing around 32 basis points of rate cuts through the end of this year. First cut now, not really fully priced in until December pretty much. Contrast that, of course, with the most recent anyway, March economic projections of the Fed. They penciled in 3 rate reductions this year. But again, that is pretty outdated now. Many officials we've been hearing from them pre-blackout, really appear more comfortable staying on pause for longer. And that is potentially the message, the key message that everyone is expecting tonight. Just contrast that, of course, just let's not forget, markets were pricing in over 160, 170 basis points of rate cuts at the start of this year for 2024. Starting in March, of course, and now we're down to 32 or so. The press conference will be key statement, maybe not much so. Be interesting whether there's major tweaks to that or not, but then the press conference, Chair Powell's press conference will be key. And again, likely to warn the path to returning inflation is bumpy, and really it's whether or how confident he is on the disinflation theme continuing or not. And as well, he may be asked about the chances of a rate hike, and there his answer will of course be fascinating. So that's the Fed really. Also, there's maybe some attention around the central bank's plan to taper the pace of its balance sheet runoff. That is expected to happen, I think, fairly soon, is what they've said, according to the recent minutes anyway. So just looking at, Fed rate expectation, you can just see how shallow that path is now. I think that's even shallower now from the date this was taken. Yeah, 32 basis points or so, and that dotted line would have been much further steeper, if you like, with those rate cuts previously priced in. If we just look at the DXY, the dollar, interestingly enough, let me just double check. You can see that. Yes, you can. Interestingly enough, yeah, the dollar has ended lower on the last 3 FOMC meetings, really, as the Fed said it wanted to cut rates. Of course, since that time, since that March meeting anyway, dollar has rallied over 2% on, of course, this US exceptionalism with price and activity data solid. Certainly, rate differentials are key now, interest rate differentials, that is, between the US and elsewhere across the globe. Geopolitical risk still lingers, although is easing back. And then we have, of course, the November US election uncertainty, potentially meaning the dollar can hold some of these recent gains, of course. So as for yeah, DXY, you can just see now we're challenging that recent high. So this is sort of bullish consolidation, although it has taken its time. That recent high at 106.51. So really interesting whether we beat that tonight or not. Then we go up to 107 and these highs, 107.11, and then that high from October last year, 107.34. So potentially a breakout, but just watch that first sign around 106.40, 106.51 actually. Yes, otherwise we move back down towards sort of 106 with those recent lows, 105.41 being probably fairly decent support, before then 105 and these peaks from February and April. I should mention as well for stocks, options are warning that they could see their biggest single day move in a year. You will may see some headlines on that, but that move is only reckoned to be about under 1% actually, so 0.95% or so. So not a massive move. So just watch those headlines where stocks, options, sorry, warning of the biggest single day move. That single day move is less than 1% potentially is what they're pricing. So yeah, that is stocks. But interestingly as well, rising stocks that we have seen, of course, have stopped really the US dollar advancing as much as really those yield differentials would suggest. So if we do get a bigger stock sell-off on the higher for longer theme, then that potentially propels the dollar higher for sure, and especially against potentially sort of the other risk currencies like the Canadian dollar, which has a high correlation to stock markets, and also certainly as well the Aussie dollar. Okay, that's the Fed. Let's just go to now the FOMC, sorry, not non-farm payrolls. I'll just show you the graphic really of the main numbers expected. Just before non-farms, we do get as well a load of other job data. We get the ADP data, never really correlates with the NFP, even though some in the media get excited about it. And then we do have as well the JOLTS job vacancy data, and potentially the quit rate is quite interesting and just shows potentially a lack of yeah, potentially an easing in labor market conditions. Again, that might point to, although whether the markets take that in with the Fed obviously tonight, and then non-farm payrolls on Friday. So that report, yeah, 250 I think is what is still expected now in April. Might have changed, and it does through the week as we get more data. The ADP, as I say, JOLTS, and then also some of the ISM employment components. But 250 at the moment for April on the back of a 303 print last time in March. Unemployment set to remain at 3.8%. Wage growth as well, sticking at 0.3%. These are all consensus expectations. I've put in here really just a astounding number that the first 3 months of the year added 829,000 jobs. That's an average of 276 per month. So really still solid gains. But that said, the pace of hiring is expected to slow in the second quarter. So surveys really pointing to quite a substantial slowing. The ISM employment components, they have sub 50 readings, which points to contraction. And then you have other surveys, really, the NFIB small hiring survey that suggests really an NFP print around 50,000. So against that, we have local government hiring still firm, and really it's just this wariness around official data, which continues to be a lot stronger than some of these private sector surveys. Okay, that is NFP. And just checking the time here. If we just, yeah, we've gone to DXY, we've done euro dollar. If we just now look at just dollar yen, just to wrap things up, because obviously that is been seeing a lot of volatility. We obviously had the Bank of Japan meeting late last week that kept the policy rate unchanged. But really it was their sort of failure really to give, well, policy engagements really didn't give any concrete guidance on the time for further rate hikes. So that disappointed markets, and we saw that break to the upside. You can see on Friday up to that high through 155, which was a potential line in the sand. Smashed through that up to 158.43, and then obviously on Monday morning early, interestingly, it was Golden Week, so liquidity much thinner in Asian hours. Yeah, popped up to 160.21 probably, the print. And a line in the sand for authorities, it seems. You can just see, if I pull back, three sort of waves of selling through the different sessions, the Asian session, then start of the European session, and then yeah, later on in the US session. So yeah, intervention really by the Japanese authorities. I think around $34 billion or so, 5.5 trillion yen. That's based on calculations from the Bank of Japan's current account balances and basically the net drain of yen funds as FX operations were settled. So it appears really a part of a new campaign for Japanese policymakers. They really seek to break this cycle of this one-way move in the yen. But of course, a really interesting time to do it ahead of the Fed meeting, ahead of NFP, which are expected to be hawkish, still expected to have strong job gains. So really kind of fighting this really powerful dollar bull trend, which could be tough and really mean, yeah, whether or what are the lines in the sand now for Tokyo. Really interesting time for dollar yen. Of course, if the Fed is hawkish, then that potentially creeps back up to 160, of course, or certainly sort of 158.50, 159. And really then we need sort of either a broad risk off move potentially, which helps the yen, or of course Chair Powell or an NFP print being lower than expected, Chair Powell being less hawkish than potentially what consensus is thinking. That kind of is probably the only way this will slow the rise and the rally in dollar yen. We shall see. Okay, I'm going to wrap it up there now. So much to look forward to on the horizon, really. So do take care out there, and we shall speak to you in a couple of weeks. Okay, take care.